All right, here's where we left off from last time. We were talking about beneficiary designation was the next thing we needed to talk about. So here's the thing. We got a primary beneficiary, and then a lot of times it's smart to name a contingent beneficiary. That person is going to come into play if the primary beneficiary dies before the insured does. Okay, so I name a beneficiary, but what if that person dies before I do? Well, if I don't have a backup, then the money is left to my estate. And we said that that's not a good thing because you could be potentially subject to estate taxes when it would have been tax-free if you just named a beneficiary. So a lot of times people set this up, they name a primary beneficiary, and then they name their backup right away. So a real common thing to do is you name your spouse as the primary beneficiary and your children as contingent beneficiaries. They don't split it, right? If you wanted that, you'd have two primary beneficiaries, right? So contingent only comes into play if the primary beneficiaries are all gone. Then we're lining up our backup in advance. You don't have to do it that way. You could wait for that to happen and then name another primary beneficiary. But it seems to be the case that most people are trying to put their backups into place first. So again, spouse for primary, children if spouse dies before the insured does. That's really common. The problem is if you name minor children, if they're under the age of 18, they legally can't enter into contracts. So what you really need to do is to set up a trust or at a minimum name a guardian to be making all these financial decisions because you're just bestowing upon them a huge amount of money. And minor children, in addition to the legal problems, a lot of times don't have the financial capacity to make the kinds of decisions that they're going to have to make. So ahead of time, this makes sense to think about to say, if you're going to name your children as contingent beneficiaries, you probably need a trust set up. That's not a terribly complicated thing to do. You'll need a lawyer to help you set it up, but it's not something that's going to take hours and hours and hours and cost thousands and thousands of dollars. I mean, if you wanted to make it complicated, you can, but it doesn't have to be that way. If you have no beneficiaries at all listed, then your estate is the beneficiary. And we said, again, that's a bad idea because then your life insurance proceeds could be subject to estate taxes, and those are fairly substantial. You also could name your estate as the beneficiary, but again, for the same reason, that's generally not something you want to do. Most beneficiaries are revocable. You can change that at any time. There are certain cases where irrevocable beneficiaries come up. One might be divorce. Part of the divorce agreement might be the children are going to be named as irrevocable beneficiaries, or the trust that benefits the children is going to be named as irrevocable beneficiaries. And that means it can't be changed without the beneficiary's permission. So careful there. Irrevocable doesn't mean they can't be changed. It means you need to get their permission to change it. And for minor children, they can't give that permission. So that's why that sometimes comes up in divorce cases. It could also come up where life insurance is a requirement to get a loan. So I'm a bank, I'm loaning you money for your business idea. The only thing I'm worried about is what if you die? So I might require, as a condition of the loan, you've got to take out a life insurance policy on yourself equal to the loan balance and name the bank, me, as the irrevocable beneficiary. And then once you've paid off your loan to the bank, yeah, I'll give permission. You can change that to somebody else or let it lapse. So irrevocable beneficiaries are uncommon, but they can come up in a couple places. You can still change them. You just need their permission. By and large, the bulk of what's happening here is revocable beneficiaries. You can change that at any time. You can name beneficiaries specifically, name and social security number. And then there's no question who's supposed to benefit from this life insurance policy. You can also use class language. So you could just say, I'm naming my children. In quotes, my children are my beneficiaries. Okay, well, that could change. If a child passes away before you do, or if you end up having more children, then that automatically means that they are beneficiaries and there's been changes there. And what it does create is a question sometimes of what you really intended. So with specific beneficiaries, there is no question. We know, no, this person, this is their social security number. That's what this person wanted. When you use class language, my spouse, well, okay, if you then divorce and marry somebody else, it's going to be whoever the spouse is at the time that you die. And is that what you wanted? That can sometimes raise questions in the heirs' minds. Well, did he really intend to do that? So you can do it either way. You just have to be careful. If you've got specific beneficiaries, when things change, then you have to update that. Sometimes people use class beneficiary language because they're thinking that, well, they won't ever have to think about it then. Maybe not. And one of the things we point out is my children is not the same as children of the insured. One of those groups includes children from a previous marriage. One does not. So the question is that what you intended? At least if it's specific, at least we know what you intended. And there's no way to make an unintentional mistake that way. Those are the things that you have to weigh. But if you choose specific, then you've got to update if things change. So that's something to keep in mind. We don't have a whole lot of exclusions in life insurance. There's only a few. Suicide is one, and we talked about it only in the first 2 years. There's a war exclusion. Every single insurance contract always has a war exclusion. And you say, well, what about how do we do life insurance for members of the armed forces? Our government has a life insurance program for them. We do that because in the private market, you're not going to be able to purchase life insurance if that's the cause of death. That's going to be an exclusion. Aviation is a little tricky. It sounds like if you die in a plane crash that you have no coverage. That's not true. Commercial aviation is covered. Private aviation is not. So if you're a private pilot or if you're riding on a private plane and there's an accident and you pass away as a result, then that's going to be excluded. But it's not a commercial aircraft. The incidents that involve plane crashes are much higher with private aircraft. That's why the exclusion is in there. That's why it's written the way that it is. So it's a little tricky. It doesn't exclude commercial aircraft disaster. Private aircraft is what it's going to exclude. Sometimes high-risk activities are going to be excluded, and there'll be a list of them in the policy, but they tend to encompass these activities that you can see are inherently dangerous, right? If you're going to spend a lot of time doing these kinds of things, your risk of death is higher. And there's a couple different ways you can handle that. Some insurance companies will cover them, but they'll rate you up. The more common way is to exclude them and say if you die as a result of these activities, then your life insurance isn't going to pay. And that's just something you'd want to be aware of if these are activities that you see yourself participating in. But I think when you look at the list, what you notice is it's a short list. There's not a lot of exclusions here. It's not like auto, and it's definitely not like homeowners, where it seems like every other thing is excluded. You don't have named perils or anything like that. No, if you die, your life insurance is going to pay, except in very rare situations listed here. So not a lot of exclusions for life insurance. All right, hinted at this before, but haven't talked about it yet. You can borrow against the cash value in a life insurance policy. So cash value, that means it's got to be a permanent life insurance policy, right? Term policies don't have any cash value to borrow in the first place. So you can only borrow against your cash value if you have a permanent policy. There's going to be a stated interest rate. In the contract, it'll tell you what you're going to pay. You have to pay this money back. It's a loan. So think about this, cash value, right? Again, people get all excited about, oh, the cash value is growing. Look at how much cash value I have in my life insurance policy. I always say, well, what good is it? Because unless you cancel the policy, it doesn't matter. It's not getting paid on top of the death benefit. Here is a place where it could matter. You can borrow against it, but you have to pay it back. If it was your money, you could just take it, right? But you have to pay it back. So that just underscores the fact this doesn't belong to you. So great, you have a ton of cash value in your policy. Wonderful. Unless you're going to cancel the policy, doesn't matter. You can borrow against it. That's nice. It'll be low interest rates. It'll be less than what you'd pay to borrow money from a bank or to take a loan out on a credit card. You know, that might be 18 to 20%. And at a bank on a personal loan, that might be 8 to 10%. This is going to be 1 or 2%. It's going to be because the money's already there. And we have perfect collateral because if you don't pay, I'm trying to get to that part. I got to the bottom part. Okay, so if you took a loan and you just did not pay, if you died, then they'll take the money from the death benefit. So they're not risking anything by loaning you money from cash value. They've got perfect collateral. You die, we're just going to reduce what we give to the beneficiary. Okay. You can pay that interest annually every year, or you can add it to the balance of the loan. You can capitalize it. And then, and you might say, yeah, I'm never intending on paying off this loan. When I die, it's going to be taken from the death benefit, and the interest is just going to be added to that amount. And so if this loan hangs on for a long, 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 long time, then yeah, there's going to be a fair amount of interest that's tacked on. It's just that the interest tends to be relatively low. So it's not going to compound into a huge amount. Again, borrowing at 1% is pretty common. Again, that cash value doesn't belong to you because you got to pay it back. It actually belongs to the pool of insureds. These rates are going to be low, said that already. And then, yeah, if you die while the policy is outstanding, while the loan is outstanding, then we take the balance of the loan from the death benefit. So I borrowed $100,000 in cash value on my $1 million policy, never paid it back, and then I die. Yep, they're going to pay my beneficiary $900,000 instead of $1 million. They'll take their $100,000 balance of the loan back right there. So it's not difficult. And that's why the loan rate is so low, because there is no risk of non-repayment. If you have a participating policy, so this happens when you've chosen your life insurance policy. It used to be that only mutual insurance companies offered participating policies. So a mutual company is owned by the policyholders. And that means if there's a profit, that belongs to the policyholders, and it would get issued in the form of a dividend. So it used to be that the only participating policies were offered by mutual insurers because you were an owner of the insurance company. But now we have stock insurers that are also offering participating policies. So it's a choice. When you buy life insurance, you want to ask, is this a participating policy or not? If it is, you have the possibility of getting dividends if they experience favorable mortality, fewer people die than they expect, favorable expenses are less than they expect, or better investment results than they expected. Those are the three places that profit can come from in a life insurance company. And if you have a participating policy, well, then you get to participate in that in the form of dividends. So that means, okay, great, I've got a dividend. I've got a $50 dividend coming to me. What can I do with that? Well, it could be simple. Pay me. Write me a check. I'll take a cash dividend of my $50 dividend payment. No problem. Or you could say, you know what, hang on to my $50 dividend and next year subtract that from what I owe you for my life insurance premium, which is basically the same thing as cash. It's just a specific way to apply it. So you could take it in cash, either in form of applying to next year's premium or just a check today. Or you could use your dividend to buy insurance, more insurance coverage. I'm going to skip interest only for just a second. So I could say now remember there's two types of life insurance. I've got a $50 dividend. I could say I want to use that to buy single premium life insurance coverage. So take my $50 and use it to buy as much coverage as I could buy today for $50 to cover me for the rest of my life. Yeah, that's not going to be very much. That might be another $200. Okay, but we're going to increase your death benefit by $200 and say with your $50 dividend, you bought an additional paid up $200 in coverage, and that's going to be with you. Your death benefit is now $200 higher permanently. That's a paid up addition. We're using your dividend to buy whole life insurance, but we could use your dividend to buy term life insurance that lasts for 1 year. So we could say, take my $50, buy term insurance for this year, and that might get you a couple $1,000s in coverage, maybe more. And then we'll say, oh, all right, when you use dividends to buy insurance coverage, you're usually thinking about this as a long-term strategy. So maybe every year you're adding another couple $100s to your death benefit, or maybe every year you're using it to buy term insurance and you're increasing your death benefit that way by a lot more. And if you do it every single year, as long as you have consistent dividends, that can really boost your term insurance coverage. If there's a year that you don't have a dividend, though, then you won't get the boost. And if you die during that year, then that strategy doesn't work quite as well. The fifth dividend option, and not all companies offer this, is what we call interest only. That says, take my dividends, keep them in a separate pool, invest them separately, and pay me an income off the interest that generates. So great, I'm going to earn the interest off my $50 while you're going to hold that for me temporarily. And so great, I might get $1 from that option for this year. That interest only option only starts to deliver money when you've had many, many dividends build up over many years. And the interest income now is something, plus you still have the principal. They're holding that for you temporarily. So those are your options. Really, there's two options. You're taking your dividends in cash, or you're using your dividends to buy more life insurance. Those are your choices. Then we got to talk about your cash value. So you got a permanent life insurance policy and you're a long way through and you haven't been able to decide if you want to keep it. You don't need it anymore. You're giving it up. Okay, well, you could surrender your cash value for cash. Or, again, we could use your cash value that remains. We could use it to convert that into some type of term insurance. Or paid up insurance that lasts for your whole life. So you could use your cash value. You're going to stop paying premiums. That's the difference, right? So it was going to cover you for, let's say, $1 million in coverage, but you had to pay premiums for the rest of your life. Now you're going to stop paying premiums. Something has to change. You've either got $1 million in coverage that's going to end at some point in future, or you have coverage for the rest of your life, but it's not going to be $1 million anymore because you're not paying premiums. So one of those two things has to happen. Either we have to shorten the period of time that you're covered, or we have to reduce the amount that you have and still cover you for the rest of your life. Those are your two insurance non-forfeiture options. So reduced paid up insurance, that is what it says. You're paid up with your cash value. You're going to use that to buy reduced paid up insurance. You're covered for the rest of your life. But if you wanted it to still be the $1 million, you'd have to continue paying premiums, and you're not going to do that. So it's going to be less. Still covered for the rest of your life, but now maybe it's only going to be $300,000 instead of $1 million. And that depends on how much cash value you've got in there. Or you could say, no, I still want it to be $1 million in coverage, but I accept that it's no longer going to cover me for the rest of my life. Instead, it's going to cover me for the next 11 years, 6 months, and 3 days. And they can tell you when you go to cash out your policy exactly how much you could get. And again, you could just choose cash. So you can either choose cash or you can choose to have your cash value applied to a different type of life insurance. And there, either we have to change how long you're covered for, or we have to change how much coverage you've got. Those are your only choices. So those are your surrender options, non-forfeiture options. When we talk about settlement options, we're talking about how the death benefit is paid. And again, it's the beneficiary who kind of has the value of seeing how this could work, but it's the owner who chooses these. So yeah, you could say, I've got $1 million life insurance policy. I want you to pay that in the form of $1 million to my beneficiary when I die. That's the cash settlement option. You could say, and this is something that this is usually the default option. What will happen is we'll say, all right, this was probably sudden and unexpected. So beneficiary, here comes this cash option. You're entitled to $1 million today, but you know what we're going to do instead? We're going to put that into a checking account for you, and it's going to carry interest because we're not going to create an investment problem for you. So instead of giving you $1 million, I'm going to give you a checkbook. Now, if you want the $1 million, you go ahead and you write yourself a check for $1 million. There you go. You're done. If, like most people, you say, I don't know what I'm going to do. It's a problem when I end up with $1 million tomorrow. It's a good problem, but it's a problem. Where are you going to put that money? Stocks are at an all-time high right now. You're going to put your money in the stock market? All of it? I wouldn't. Bonds, have you looked at interest rates lately? They're terrible. I wouldn't be excited about locking into low interest rates forever. So all of a sudden, I've got this $1 million. I don't know what I want to do with it. Maybe the best option is just, temporarily give me access to it. So if I find something, I can do something right away. But why don't you, let's put this in an account that's bearing interest so I can have some time to consider what I want to do. Financial planners will tell you if you get a big windfall, you should not spend any of it for 90 days. Give yourself 3 months to think and plan and make some decisions. Don't decide tomorrow. That leads to bad financial decisions. There's no rush. There's no expectation that you have to do this tomorrow. So this can be a really useful option. I could say, you know what? Pay me that $1 million out over the next 20 years. Okay. And they do the math and they say, all right, sounds like we're going to be paying you about $50,000 a year. It's about. It's going to be a little bit more than that because the unused balance is going to be collecting interest, right? So, okay, in the first year, you pay me $50,000. There's $950,000 left. That $950 is going to accumulate interest. So if I want to pay it out over 20 years, it's got to be a little bit more than $50,000 every year, right? Otherwise, there would be money left at the end of the time in the form of interest. We could do it as a fixed amount. Pay me $50,000 a year till it's gone. Okay. That's not very different from what the fixed period option is. And again, we've got interest accumulating there to make sure that I get more than 20 years at 50,000. I'll get a little bit more because there's interest involved there. Or, and we haven't talked about annuities yet, I could say, if I'm at the right age for this, I could say, pay this out over the rest of my life. I want to convert this lump sum that I have, this $1 million that I have, into an annuity where you're going to pay me the same amount every month for the rest of my life, no matter how long I live. I live to be 150, that's your problem, you're going to pay me. And then obviously, should I die shortly after making that decision, that's going to look like a bad decision in hindsight. And so you have all the annuity options with those. We haven't talked about those yet, but we will. You could say if the beneficiary was retirement age, a life annuity might make a really good purchase instead of a lump sum. So these are all personal preferences. The problem is the person who's getting the money is the beneficiary, and they're not the ones who get to choose. It's the owner who gets to choose. And so is that really what the beneficiary wants, or have I just made it harder for them? Because the beneficiary, I might say, all right, my child is 20 years old and I don't want them to get $1 million lump sum, so I'm going to give them a fixed period option. That's what I'm going to elect. Well, the problem is after I'm gone, the beneficiary, my 20-year-old child, can go right back to somebody else and say, hey, I want to turn this into a lump sum, and they'll be able to do it. So I can't stop them from doing it. All I can do is make it more complicated and more expensive. There will be somebody out there who, for a fee, would be more than happy to take your annuity and turn it into a lump sum, right? J.G. Wentworth, 877 cash now. That's what they did, right? Now, you have a structured settlement, but you want cash now? Call J.G. Wentworth. They would do it, right? I don't even know if they're still around. They just had a great commercial. That's all. I still remember this. This is 10, 15, 20 years ago that they were advertising, but that's what they did. They would charge a fee to do it, and that was their business. So yeah, I can try to tie my beneficiary's hands a little bit by selecting the fixed period option. But if they're bound and determined to have a lump sum, they can get it. They're just going to lose some of the value by paying somebody to do that. Worth talking about some of the riders for a second. Waiver of premium rider. So this is something you're adding to your life insurance policy. We said this is the one that says, should you become disabled, you no longer have to pay insurance, life insurance premiums for the period of time that you're disabled. Once you're healed back up, then they're due again. We do this because when people are disabled, they suffer a loss to income. They also usually suffer increased medical expenses. Money gets tight, and life insurance is sometimes dropped. We don't want you to drop your life insurance. Your needs probably didn't change. So if you buy this rider, we can make sure that at least your life insurance can stay in force and you don't have to pay a premium. That could be a very valuable benefit to have. Check into this one. It's not terribly expensive. This is usually something that's worth considering. Guaranteed purchase option says if you want to add life insurance coverage, you can do that at intervals during your life insurance, during your life, usually every 3 years or after certain events like birth of a child or marriage. We will give you the option to increase your life insurance by a fixed amount. You can't double it, you can't triple it. But every 3 years, you might be able to increase your $1 million policy by, say, $100,000. And that's regardless of health. If you knew you were going to be healthy, this option is worth nothing. Because then if you needed more, you just go out and buy more, no problem. This helps guarantee that if there's a change in your health status, now you're no longer able to pass a life insurance qualification. You aren't going to be able to get through the underwriting. If you bought this option, we don't even care. You're entitled to increase by that fixed amount every 3 years or whenever you have a certain life event. So that's a rider that you attach to your life insurance policy. Accidental death benefit rider. This one pays you double if you die as a result of an accident. Your author doesn't like this one because your textbook author says, look, if you die, that creates financial problems for your family. It doesn't matter how you die. So the idea that you should give yourself a double payment if you die accidentally, what you're really doing is you're just gambling on how you're going to die. This doesn't really help your family. If you've got extra money to spend on life insurance, your author says, don't buy this. Use that money to buy additional life insurance. And then it doesn't matter how you die, you'll have the increased coverage. So accidental death benefit rider, that's one way to purchase it. They also sell accidental death insurance as a standalone product. And sometimes you'll see that if people can't qualify on their own, their health is not good enough, Well, now we're worried about them dying as a result of illness. So we're not going to write them life insurance. We can write them an accidental death insurance policy because that's something that's not predictable and that's something that's not influenced by your health status. So sometimes we can write this policy as a standalone policy. We still have the same problem. If you die, your family has needs and they don't depend on how you die. We can buy a cost of living rider that will gradually increase the face amount of your insurance coverage. So this one is automatically increasing it by a few percent every year to cover the cost of living. The idea is, yeah, if you got a death benefit payout today of $1 million, that would cover your needs. But 25 years from now, if you got a death benefit payout of $1 million, it might not be enough. This helps keeps the purchasing power of that $1 million constant because we're going to increase that $1 million by a few percent every year. It's a rider. You have to pay extra to add this to your life insurance policy, but these are all riders that are worth at least considering, with the exception of accidental death. I would say, again, like the author of your textbook, I agree with him. If you got extra money to spend on life insurance, use it to increase your coverage from all kinds of death. Then the last one that I want to talk about is accelerated death benefit rider. This one says, should you end up with a terminal illness, that we will allow you to access your life insurance benefits a little bit early. You don't have to actually die. And that can be useful for a bunch of reasons. Maybe there's a medical treatment that's expensive that you want to pursue and you don't have any money. This might be a way to get your money. You can access your death benefit early. Maybe you just want to use that money to go on a trip around the world and fulfill some last wishes. You can do that. There's no rule that says how you have to spend the money. If you've bought the rider, if you come down with a terminal illness, and that's a doctor saying that your life expectancy is less than a year, if you can prove that, then you can have access to a portion of your death benefit, usually up to 50 or 75%. You usually can't get the whole thing. And that's the accelerated death benefit rider. Again, it's a rider. It's extra. You have to pay extra to add it to your life insurance policy. But if you do, and you come down with a terminal illness, you'll be able to access a portion of your death benefit prior to death. Okay, that's a good place to stop for this lecture. And we'll pick up with this new break on the next one. And we've just got a few tips for buying life insurance. That'll go pretty quick, and then we'll move into annuities. Thanks a lot.